I start talking. Number one, what I want you to take away from this lecture is that crack addicts need houses too. And number two is that I will be making jam-related jokes the whole time. So let's get started. I want to start this real naturally. First we're going to talk about, we're going to talk about how we even got into purchasing real estate as basically a commodity and not like as a home. So basically, real estate wasn't really a big investing, thing up until basically it got really big in the 90s. And the reason is because in 1999 the stock market crashed, and nobody was happy about that. So people saw that okay, the stock market's not as steady of an investment as I thought it was. So I'm going to move my money from something that's risky, like the stock market, and move it to something that's stable, which is housing. So we saw this huge influx of money going into banking, and this huge influx of money going into housing. And that's great for some investors, but the problem was it kind of made the price of housing go up. Because if anyone taking economics, whenever demand for something goes up and people are buying up houses, the value of that thing is inherently more than it was before. So I'm going to put this out there. So basically, what we're going to talk about today is what happened in 2008. So can anyone tell me what happened in 2008? A quick, literally a sentence.
People took out loans.
No, just what happened, in general. Macroeconomically, what happened?
The housing bubble.
The housing bubble pop. Okay, so what we're going to talk about today is the housing bubble and housing today. So the first thing we want to talk about is something called a CBO, which is a collateralized debt obligation. Basically what happened was all of these banks were giving out loans to people, right? Even if they really couldn't pay it back. So basically what they did with these loans is that they bundled it up into a collateralized debt obligation, which is basically taking all of these people's mortgages, putting it into this one thing and selling it to investors. That way the investors could collect money on the mortgages without actually having to buy a home. So what happened with that is they take all these really great people, let's say Will is a very successful businessman. He's trying to buy a home. He takes out a mortgage. His credit score is near perfect. He's not expected to default on his loan at all. So he receives a certain rating for his loan. So basically, we're going to split it into three categories. It's a lot more complicated than that at the time. We're going to split it into three categories. Why are we passing around my jam? Please pump up the jam over there. So, no! Okay, sorry. So we're going to split it up into three categories. The first are going to be businessmen like William Christou here. The next are going to be Danielle Ortiz, which are kind of hippie-like, and they're maybe going to pay back their loan. So they don't have the best credit score, but they don't have the worst credit score. And then we're going to do crack addicts, right? So crack addicts are what's wrong with crack addicts? Always crack addicts. So crack addicts are the lowest tier on that pyramid, right? And so, look, as much as crack addicts kind of suck and they do a lot of crack, they need to live somewhere. So a bunch of crack addicts were hey man, can I buy a mortgage? And they went into the bank, and the bank was yeah, sure, why not? Yeah, here, take a mortgage, 0 interest. Because what they were doing with that is they didn't care if these people paid them back. They were going to sell it off to some investor who thought they were going to pay them back, right? So a CDO, the collateralized debt obligation, is basically I took, let's say, 1,000 crack addicts and layered it on top with 1,000 Danielle Ortizes, and then put 1,000 William Christous on top of that. And then I got an agency, which I don't remember the name of right now, but there were a couple agencies that used to rate how well mortgages and how likely you were. What is it? No, I don't think it's AIG. It was something else. But they basically rated these. I don't care. It doesn't matter. They rated these mortgages, and they rated them from okay, this collateralized debt obligation, the CDO, is rated as an AAA, which means you're definitely going to get your money back. This one's an AA, which means you're most likely going to get your money back. Goes all the way down to F, right? So the thing is, a lot of times what happened was, because there were so many William Christous in the bunch, a lot of people ended up these companies ended up rating these collateralized debt obligations much higher than they actually were. Because they were diffusing the crack addicts with businessmen. Does that make sense? You guys get that? Anyone have any questions real quick before I go on? Okay? So basically that's what happens. So they take this collateralized debt obligation and they'd sell it off to an investor. So an investor would come in and say, All right, so there are 3,000 people in this collateralized debt obligation. I already checked with this rating agency. They say this package is AAA. It's the best it can be, right? And it's going to cost me, let's say, $10 million. But I'm going to get the amount in mortgages back. I'm going to get, let's say, $100,000 a month. So obviously they're not making their money back right away, but they're making a good chunk of change. Because what happens is when you have an exorbitant amount of wealth, when you put it in a bank, you're making negative money because of inflation, basically. And because banks don't offer the same, like, what's it called when you put money in the bank and it accumulates interest? They don't offer the same interest rates that they used to. People, really, really rich people are constantly looking for places to put their money. So what happened was a lot of rich people bought these collateralized debt obligations, like almost sure that they were going to get their money back, because these rating agencies were very well credited. So they were sure that they were going to get their money back. It's a great investment. I put in $10 million now. I get $100,000 a month for the next, let's say, 10 years, right? So they get a certain percent back on their investment. Just like if I bought a house right now. Let's say let's shrink this down. I buy one house right now for, let's say, $50,000, right? I buy that house and I rent it out to someone for $2,500 a month. Now, what I do is I take the $50,000, I divide it by 2,500, and whatever number I get, I convert it to a percentage, and that's the amount of interest I am making on my deal. So as opposed to my 50 grand sitting in the bank, I am now using my capital to obtain more wealth. So that's a really good thing, because now people are like, not only that, we're not keeping money in our banks, we're stimulating the economy, because we're allowing people to invest in these collateralized debt obligations. Only problem was they were complete horseshit. So what happened was, it was this bubble, right? So houses started to get more and more expensive. But it was fine, people were getting richer and richer, like our real wealth was skyrocketing because of all like the real wealth we had. So this bubble was getting bigger and bigger, and that's the definition of a bubble. When something gets very, very expensive, and it pops when people default on loans, right? So if we were to have a student debt bubble, right, like you know student debt is growing and growing and growing, some estimates say that that bubble will eventually pop and people start defaulting on their loans. So what happened was in 2008...
Omer, mind if I just cut it real quick?
Yeah, sure.
I don't know, I feel like you skipped over the definition of a little bit. Just like a bubble, something that's, the value of something is artificially inflated. That's it.
Okay, yeah, so that's basically what I said. Like, the volume just keeps getting bigger and bigger and bigger because people are getting more and more loans. So what happened was in 2008, the bubble popped. Like, people started just defaulting on all of these loans. And honestly, that was a big part of it. What's something that people ignore often is that if I bought a house a day before the crash for $400,000, and the next day it's worth 50 grand, it's not worth it for me to pay the mortgage of $400,000. I would just abandon the house, abandon the mortgage. I'll take the hit to my credit score. It's not worth paying $400,000 for a $50,000 house. It just doesn't make sense. So the reason a lot of these people started like a lot of the economic turmoil happened is because people started defaulting on their loans, and then so there were foreclosures. Foreclosures meant that there were more houses on the market because the banks were trying to sell them. The more houses on the market, the less your house is worth. So this kind of all happened very fast, like within like a day or two, maybe even a week. We didn't see like the actual signs until like one day, so really no one knows how long this has been going on. So the value of these houses just boom, like fell. So people were underwater on their homes, right? That means that you are paying more for your house than it is currently worth. It's underwater upside down, it's all the same. So they were underwater on their homes. So what happened was all of these banks, banks and investment firms, they all lost a ton of money, like huge, exorbitant amounts of money. What happened was the government had to step in and, of course, bail them out. Because the idea of banks then was that, like, no matter what happens, even now I think a little bit, no matter what happens to this bank, it's so ginormous and there's so many people like putting money in and out of this bank that it'll never fail. Which is why they call it too big to fail. which is why they call it too big to fail. Like the bankers believed that they were just so exorbitantly wealthy. Like their banks were worth so much money and they were such a staple in the economy that if they failed, even if they did by some weird twist of the mind failed, then the government would go and bail them out. So here was the problem. We were facing this huge amount of unemployment because this set shockwave throughout the whole economy. So we were facing like, what was it, like 12%? 12% we were facing a lot of unemployment. It really was a recession. So what's happening now is that I'm sure any of you that were here for last week's, we talked about the Treasury, how the Treasury artificially lowers interest rates so that people can take out loans to buy homes, to take student loans, etc., etc. So what happened with that is we were in a real jam. We were in a real jam, and so the Federal Reserve enabled people to start taking out more loans because at the time no one wanted to take out a loan. Like, nobody. The interest rates were incredibly high. Everyone was like, shit, like this, everything went to shit all at once. People woke up in the morning and they lost their jobs, their house was worth nothing, and like, suicide skyrocketed. It was an awful time. But we were all like 10, so it was cool. So, like, we were like, what are you crying about? So anyway, basically that's basically what happens. Does anyone have any general questions about what I just said? Anything?
I have a question.
What's up?
You said that people didn't want to pay the value of the house went down,
Yeah.
and then they didn't want to pay it off. Is that like one person faltered and then everything went to shit? Kind of.
No. Okay, here's what happened. People started defaulting on their loans because they obviously couldn't pay it back.
Okay.
So like the crack addict would go into the bank and be like, hey man, can I get a loan real quick? And he's like an IV in his arm. Oh sorry, that was my heroin needle, my bad. And so like these bankers are like, I don't give a shit. I'm making tons of money for the bank. Here you go, buddy. Here is $300,000. Go buy that house. And the banker was like, all right, I get to put this in a CDO. I can sell this to some idiot investor. It's gonna be freaking awesome. And they did that. And then the crack addicts just didn't absorb enough crack. And so there was a lot of crack being done. And so he couldn't pay back the loan. And so he went underwater on his mortgage. And what happens when you go underwater on your mortgage is the bank takes your house. And they take your house and they're like, we're repoing everything. That's where you see the repo guys. We're taking everything. We're going to try to make back the money we lost on you. So what happened was there was a huge flood of all these houses that were being foreclosed. So basically what happened was that happened and then all the values of the houses went down. So because the values of the houses went down, people walked out on their loans because they didn't want to pay them. So, I mean, the housing market today is going like pretty well. Like the value of homes is starting to steadily increase. So we're seeing a small increase. Now, I want to clear up one thing. A lot of the times when you see newspapers and magazines like, well, the value of homes today is nowhere near the peak of 2007. We don't want that at all. Like, we don't want it to get to 2007. Remember, it was a bubble, so it was artificially increased. So whenever you hear like news like, well, the peak of 2007, it's still down 50%, you say, fuck you, news anchor, you don't know what you're talking about because we don't want it to be anywhere near that high. So, yeah, the housing market's going
As high as like crack addicts?
unless it's real, which it won't be. It wouldn't make sense. Unless we all of a sudden had like 300 million people coming to the country. I don't know. So like,
The point is, you don't want to be high.
we don't want to be high. We want to be moderate. We want to be good. So the housing market's going pretty well, and I mean that's about it.